There's a reason the boring option outperforms so many exciting ones. Index funds don't try to outguess the market. They buy the whole thing, thousands of companies in one shot, then step out of the way and let capitalism do its work. No dart throwing. No stock tips from your coworker's cousin. Just broad ownership, microscopic costs, and time. Think of an index fund as a sampler platter for the economy. Instead of betting on one restaurant, you're buying the entire food court. When a few stalls flop, others boom, and the whole plate keeps moving forward. That built-in diversification is the point. You don't have to be right about who wins the next quarter. You just need to own the winners when they arrive. Costs matter more than most people realize. Fees are the slow leak in your financial tires. An index fund with an expense ratio of, say, 0.03% takes 3 cents per $100 per year. A flashy managed fund at 1% takes a full dollar. That difference sounds tiny until you let it compound for 10 or 20 years. Low cost isn't a perk with indexing, it's the engine. How do I actually do this? Start with a simple core you can explain to a friend in one sentence. For many people, that's a broad total US stock index plus a broad international index, and maybe a total bond fund for stability. If you prefer one button, a good target date index fund can wrap all of that into a single ticker and automatically adjust the mix as you age. The litmus test is this. If you can't describe your portfolio on a sticky note, it's too complicated for a set-it-and-forget-it plan. Your mix, stocks versus bonds, isn't about courage, it's about timeline. Money you need in the next 3 to 5 years shouldn't be riding stock market swings. Money for future you can handle volatility in exchange for growth. Stocks are the drama and the payoff. Bonds are the steadying hand that lets you sleep. Pick a blend that lets you stay invested when headlines get loud, because staying invested is the whole game. Automation is where good intentions turn into results. Set a fixed contribution on payday into your chosen fund or funds and let the calendar do the heavy lifting. You'll buy when prices are high, you'll buy when prices are low, and you'll avoid the trap of waiting for the right moment that never announces itself. Dollar cost averaging is boring by design, which is why it works. Rebalancing is housekeeping, not heroics. Once a year, check whether your mix drifted. If stocks had a great run and now crowd more of your portfolio than you intended, nudge them back by redirecting new contributions or moving a little into bonds. It's a 5-minute chore that quietly enforces buy low, sell high without pep talks. Taxes are part of the design. Use tax-advantaged accounts first, 401k, 403b, IRA, HSA if you have one, so more of your growth compounds without a yearly tax bite. In a regular brokerage account, prefer tax-efficient index funds that don't kick out lots of taxable distributions. When you need cash, plan sales so you're realizing long-term gains, not short-term. None of this requires gymnastics, it just rewards planning the shelves where you store things. What about the news cycle, the next election, the hot new sector your friend swears is a lock? Indexing is how you admit you don't need to predict those outcomes to succeed. The market has already priced in every opinion, hope, and fear from millions of participants. Chasing themes feels exciting, but excitement isn't a strategy. A written plan is. Common detours sneak up on smart people. Analysis paralysis, spending months picking the perfect fund, costs more than picking a perfectly fine one today. Performance chasing, buying last year's winner, often means arriving right as the party ends. Over-diversifying, owning 7 funds that all track the same index, creates complexity without benefit. The antidote is simplicity you'll actually stick with on your worst day. If you want to nudge on proportions without a spreadsheet, keep it rough and human. More years until you'll need the money? Tilt towards stocks. Getting closer or sleeping poorly? Add bonds. Want global exposure without thinking about it? Use a total world index and call it a day. The market doesn't grade you on elegance, it rewards consistency. You'll have wobbly months. Prices will drop. Headlines will predict doom. That's not a signal to reinvent your plan, it's an invitation to reread it. Volatility is the admission price for long-term returns. If you've matched your risk to your timeline, the correct move during turbulence is usually to keep buying and go outside. And because you're building this for a life, not a week, tie it to moments that already happen. When you get a raise, bump your automatic contribution before the new money hits your checking account so you never feel a cut. When you clean your closet in spring, clean your portfolio by rebalancing. When you renew your car registration, take 2 minutes to peek at your contribution rate. Anchoring money habits to calendar moments makes them durable. Here's the quiet payoff. Index investing frees your attention. Instead of micromanaging tickers, you spend energy on the parts of your financial life that move the needle. Earning more, protecting your downside with insurance and an emergency fund, designing a spending plan you actually enjoy. Your portfolio becomes the background track, steady, dependable, compounding while you live. So pick a simple index core, automate the deposits, rebalance once in a while, and go do something better with your Saturday. The market will do what it does, rise, fall, rise again, and your job is not to outsmart it. Your job is to own it cheaply, hold it patiently, and let time make you look brilliant.